All right, let's go ahead and get started. Thank you to those who are online live. And of course, we record this session and will be editing some of the beginning of this and anything else that I mess up throughout this presentation. And we'll put the recording on YouTube. So thank you to future listeners. We do have we have many people that watch these later, so just want to say a quick shout out to you that are listening. The convenience of technology to work these things in when it's convenient for you. We really appreciate it. Thank you for listening, and please subscribe and follow along in our monthly series. Before I forget, also check out our website where we do have a series of white papers and blogs, including and we'll talk about it later, but including a white paper on today's topic, which is tax for businesses and tax planning, really. And so there's a very nice white paper there. Before I also get started, I wanted to just say publicly thank you to Erica, my assistant, who helps me out very much behind the scenes and really appreciate it. Oh, she just put the link to the white paper in the chat, so look for that and appreciate that. And good timing, because I was just saying thank you to Erica for all the help that she does in arranging these sessions, helping me with materials, other marketing and educational materials, and reaching out to clients on my behalf. So just wanted to say thank you to her. I really do appreciate it. And uh, and and she helps the firm out a lot. So it's we're recording this on April 17th. And the subject is taxes. And somebody might say to me, why are we talking about taxes on April 17th, 2 days after the American tax deadline? We don't want to talk about taxes until next December. And then if I don't have to, I don't want to talk about taxes with my tax accountant until next April. And that's the very point for why we're talking about taxes today, to emphasize the importance of thinking about taxes throughout your business life cycle, and to raise awareness about the fact that taxes is one component of running an effective and growing business. And taxes is not something to think about in December only and in April or March when you're filing corporate tax returns. Taxes is something to integrate into your business, just as there are many other things that we've talked about over the past coming months and what we'll talk about in the um, taxes are a byproduct of quality finance, which is what we're really talking about here. Tax planning happens all year. Decisions made today might affect and will affect next year's tax position. And so really we're just wanting to talk about that and to instill that into the discussion. Hoping everybody can hear me. I'm seeing a warning that my Wi-Fi, or actually my direct plug-in, was unstable. So hopefully everybody can still hear me, but it looks like it's back online now. Um, I think that's really what I wanted to say in terms of my introduction, and we'll just move on. We are going to talk about 13 things, and it is a lot. And this is not going to be a session where we are throwing out IRS tax codes. There will be a couple mentions of some codes, but really what I'm trying to do is highlight and raise awareness about a few things that are common in terms of tax planning. You now have an opportunity between now and December to implement some of these issues, and hopefully you'll get nuggets that you can apply in your business. And obviously we're wanting to instill a community where we're engaging and asking questions and talking and just raising awareness. So if you have your own tax accountant that you're comfortable with and happy with, then by all means make sure you're taking note of and going back to your tax accountant and asking them for help. Of course, we are in business to help business owners. And if there is any question about any of these things and you want to have a conversation, we are always open to having a conversation with you, even if it's just a high level, quick conversation to confirm that you're on the right track or not, or give you some nuggets and you can go back to your own tax accountant. We're here to help you. If we can be of service for you as your accounting firm of record, great. But we're really just trying to raise awareness and help you have some ideas. So I'm not going to routine of these things, but I will point out a couple things. Just I'm really excited to talk about a few of these things because I think they're big picture and important issues that are maybe a little complicated, maybe a little unknown, and so we're really looking forward to that. And again, if I had only 30 seconds to talk about this, the point, excuse me, the point is taxes in the business are not something we talk about in December just before year end or in March or April before filing corporate or individual tax returns. This is something that you need to think about on a regular basis because some very often think it's too late. And so we just want to instill the concept that you should be thinking about these things, talking about your advisors, talking with your team throughout the year. But a couple things here. Entity optimization. Now is a great time if you're a growing business and you're an LLC, now is a great time to evaluate whether you have the right corporate structure. Overpayment is another thing. You have maybe if you haven't extended, and that's the other thing. There are lots of companies that might not have all the records done yet. The hopefully you've made your estimated payments, but you've not actually filed your tax return. So some of these things might be germane to you, even for your 2024 filing. And one way or the other, you probably, hopefully, have some sense for what your tax bill is, what your estimated payments are. You've made your estimated payments for the 2024 year as well as your first quarterly payment for 25, but we can talk about those things. What are a couple other things? We're going to talk about timing issues and throw out some strategies and questions you can be thinking about. But again, the gist of this is just to be thinking about these things throughout the year. All right, let's get into a few of these things, and we're going to just start going through these 13 items. As we've commented here, if you have questions, feel free to put them in the chat, and I think we will end this session with a few questions that we've thought of that are not necessarily a part of the formal presentation, but are germane to these topics. So looking forward to that. Number one is really just a a setup for why we're here today. What to do after filing your taxes, assuming you filed your taxes. Again, you may have extended, but what to do. One is to think about things as we're talking about today. Review your return with strategy in mind, not just compliance. This tax return is really a report, and a lot of companies have formal, and you should even internally have formal financial statements using an accounting system. But very often, the tax return is the formal report that is given to lenders, et cetera. So review the tax return with that in mind to understand what the story is that is being told by that tax return. Check for overpayments, misclassifications, misdeductions. Again, we're going to talk about all those things. Create a checklist, write down some questions, and that's item number one. Item number two, did you overpay? And that is a comment that is very often brought up when a tax return is discussed. Number one, do I have a refund or do I have a payment? And there might be some perceived annoyance that maybe the accountant didn't help right, and I had to make a big payment, which means that the amount wasn't, the tax return wasn't done properly, et cetera. So let me just say, and I've said this before in other social media posts, the actual refund or pay amount due in my opinion, is not the most important statistic to be following. What you should actually be following, more importantly, is the actual amount of tax as a portion of your total earnings and your total cash flows and your total financial position. So I would want my clients to understand what is the tax bill? What's the total tax bill? And then the overpayment and settlement is really just a byproduct of that amount, because in theory, you're making payments throughout the year. The U.S. government is has set up rules that says we want you to pay your taxes as you earn them, not at the very end. We don't want you to wait. If you've earned a buck, we want those taxes on a pretty timely basis. Think about for your employees, or think about the days when you were an employee and you would receive a paycheck and you would have your withholdings taken from your paycheck, and those the employer then remits those to the federal and state government. So that's because the federal and state government wants those taxes from income on a regular basis. So the U.S. government wants that to continue to be the case for businesses as well. And so there is a concept of they don't want you to have to make those payments on a weekly basis. That's too much of an administrative burden. But there is a quarterly, they call it a quarterly schedule, in which you are required to make estimated payments. And it's a truth that you can understand throughout the year what your ballpark tax bill should be, and you can fluctuate those estimated payments. But the overall rule, in order to avoid penalties and taxes, and I put this in that bottom box, the overall rule to avoid penalties and interest in your tax return is to make sure that you pay at least 100% of the prior year's tax bill through your estimated tax return payments, um, or 90% of what you owe for this year's tax return. So that's what needs to happen in order to avoid penalties and interest. But that doesn't mean that there might not be a large tax bill if you're not estimating those and managing that process. Of course, there is a school of thought that you don't want to pay too quickly and have the government have access to the money before you do. And certainly that is true. And there's a materiality impact there, and it also just depends on how you want to manage your cash flow. At your tax filing, do you want to have to come up with cash and pay that in? Do you want to have monies coming back to you, or do you want to get that as close to zero? And again, there's multiple schools of thought there. And if it gets to be too big, certainly time value of money could come into play. But really, we want you to manage what I'm trying to say with all this is I want you to manage your cash flows in a reasonable way. And there's no right or wrong answer there. But understanding a couple of those things, I think, is important. How to avoid penalties and interest, and then just understand how you want to manage your cash flows. All right, let's keep going to the next item: missed deductions, and what are some of those missed deductions? And my overall point in this slide is it's important to make sure your tax return is a byproduct of your accounting systems, your financial reporting systems, and it's important for you to separate your personal and business activity. And all of your business activity that is needed in order to effectively run your business, whatever those might be. They might be marketing costs. That might be entertainment with customers and clients. That might be meals. As long as you can show a true business purpose for your spending, then those should be reflected in your financial statements, and then hence they should be reflected in your tax return. But we put a few of the other things in here as well. Business use of home is a commonly used strategy to add a few bucks to your deductions, and that might even include if you have a main office, but you can document that you do legitimate work at your home, maybe you perform customer work at your office and you perform all your administrative work at your home, it's a truth that you might have office expense as well as a legitimate opportunity to have business, excuse me, have a business home office deduction. And again, the importance in all of this is to properly memorialize and be prepared for those questions that might come up. But just wanted to bring that up. Other things, of course, if you are using vehicles, equipment, you want to make sure that you get those into your financial reporting and then into your tax return. If your staff are traveling for your business and you want to make sure that one, they're not taking on that burden of working for the business on their own dime, then you can set up an accountable expense reimbursement plan, get the expense onto your financial statements, into your books and out of their hands, and then those become deductions for your business. Uh, those are a couple of the things that come up, and there might be other opportunities, but the gist of it is think about what you need to do to run your business, make sure they're reflected in your books, and then go from there. And you'll capture a lot. And if there are questions about that, then certainly you can talk with us or your accounting professional. Finding hidden tax opportunities. What are your financial reports really telling you? And certainly that is an interesting thing. And again, we continue to talk about just making sure you have good accounting systems so that your tax return preparation process is a simple byproduct of that reporting. So review your monthly reports for tax saving behaviors, red flags. I meet with clients all the time to talk about various expense categories. There's a difference between running your business for quote maximum or optimizing profitability and then contrasting that with managing your tax bill. So that's a thing. We're going to talk a little bit more about this with the second bullet, but I'm going to talk about it now as well. And that is the concept of whether disbursements that you're making for your business are considered expense or whether they're considered capital expenses. And the difference has to do with whether that is a immediate expense in your financial reporting or whether the useful life of that purchase is multiple years. In the accounting world, as well as generally in the tax space, if you are purchasing an asset that has a multiple year life, i.e., a vehicle, a building, a piece of equipment, the use of those purchases, you'll enjoy the use of those over multiple years, even if you lay out the funds today. So the concept is we want your accounting systems to reflect the fact that you're using those disbursements over multiple years through the concept of capitalizing those purchases and depreciating them over multiple years. So the financial reporting would say, put those in the right buckets, identify those, and then account for them properly in financial reporting. And then we'll talk about a few exceptions where the government says, we want you to invest in capital items. And so we'll incentivize you to invest in capital items by allowing you to have essentially a second set of tax books, tax methods in which you will, despite the fact you're expensing them for your regular accounting over multiple years, will allow you to accelerate those deductions in either a faster life or even in a single year. So we'll talk about those. Excuse me. Look for timing opportunities in receivables and payables, and we'll talk about that a little bit more later. But the concept, most people are filing their tax return on a cash basis. So that means that they're paying taxes as income is actually coming in and as they are actually paying their bills. So your accounting might be done on what we call an accrual basis, meaning you provide a service to a customer or a client today, they pay you in 30 days. On an accrual basis, that is revenue to you today, but on a tax basis, that you won't actually pay taxes until you collect those payments in 30 days. And that's an important distinction to understand. And there are strategies involved as to whether you should file your tax return on a cash basis or an accrual basis. I would say by and large, most clients that I've worked with over the years prepare their accounting financial statements on an accrual basis, but they file their tax return on a cash basis. Why pay taxes on a tax bill that why pay taxes if you haven't actually collected the money, which gives you the cash to pay those taxes? So that's the concept. But there are legitimate reasons, and I ran into them as recently as in the last month, where there are opportunities and there are reasons for converting your tax basis to an accrual basis. If you're having large losses, and just as an off the cuff thought, if you're having large losses, then there might be an opportunity to convert your accounting method to an accrual basis. But the gist of what I'm talking about here is just to be aware of those issues, and we'll talk about a few of those other matters around collections and timing later. Quarterly tax reviews, whether it's quarterly, semi-annual, 3 times a year, the gist of this point is why wait until year end? If you wait until December, then there might be opportunities that you could have taken advantage of in the summer because it might take some time to put the strategy in place, that you will lose that opportunity because you're not talking about it until December. So we want to be talking about tax issues and strategies throughout the year. Another thing that comes to mind, if your business is growing or declining, if your business is materially changing one way or the other, that will most likely impact your tax bill. And if you are just paying quarterly estimated payments based on last year's tax results, then you will most likely avoid those penalties and interest that we talked about, but you still might be you might be headed towards a scenario where you have a large tax bill, maybe no penalties and interest, but you still might have a large tax bill. And if you aren't aware of that, and that might be okay with you, but if it were me, I'd want to understand that tax bill coming down the line. And the only way you do that is you have tax reviews and understand those things throughout the year. So we've talked about a lot of those things already, and we'll leave it at that. Hopefully that made sense. All right, entity optimization. Are you still in the right structure? This is a good one. Most people that I talk with are LLCs. And so let's just step back and talk about this for a second. You have started your business, and maybe on day one you start your business by just hanging a shingle and not really doing anything other than hopefully setting up a business bank account. Actually, I would say there are 3 foundational things you should be doing as you set up a new business. Number one is get a business banking account. Number two, set up an entity structure. It's not morally wrong or anything to not do that, but we'll talk about that. And number 3 is obtain business lines of credit. Those are the 3 foundational things that all business owners should be doing pretty close to day one. But many people will just hang a shingle and start operating as a business from the very beginning as what we call in the accounting world or the tax world a Schedule C business. You're essentially functioning as a sole proprietor without a corporate structure. Nothing wrong with that. You'll file your business activity in your personal tax return. There are legal and other reasons to set up an LLC. None of those have anything to do with taxes. If you are a single member LLC, for example, there is no distinction in your tax bill between being a sole proprietor without a corporate structure and a single member LLC with a corporate structure. There's no tax difference. All of that will flow through on your personal tax return, but it'll give you better access to business banking accounts. It will give you access to better um, uh, business lines of credit, and you'll have some legal asset protections by separating your personal and business assets. If you're functioning as a sole proprietor, essentially all of your personal assets are in play as you perform your business. With an LLC, some of those matters are protected. Certainly not an attorney, but I know enough about it that's really why people set up an LLC. As you set up an LLC and begin operating that business, and let's say you have earnings, hopefully you have earnings pretty quickly. And when you do, we'll talk in some examples. As you earn those earnings, you will pay taxes on the profits of that business. And let's just use an example, $100,000. You'll pay taxes on that $100,000 in the form of income tax. But you'll also pay what's called self-employment tax. That self-employment tax is akin to the Social Security and Medicare tax that is owed if you're an employee. Think about the days of when you were an employee, and think about your own employees. When you make payroll, you are taking out of that employee's paycheck 7.65% for Social Security and Medicare, assuming you don't hit some of the limits, which we're not going to talk about today. But you're going to take that out, and then you're also going to, as an employer, make a matching contribution of 7.65%. And you will pay to the federal government a total of 15.3% of all those wages, half of it coming from the employee, half of it coming from the employer's earnings and revenues. And that gets remitted to the federal government. Well, the IRS has said just because you become a business owner doesn't make that obligation go away. So you still have to pay to the federal government that 15.3% for all of those earnings. That's what self-employment tax is. It's a payment in lieu of what you would have paid as an employee. It's a truth. So that means that you'll be paying income taxes plus that 15.3% self-employment tax. And as your business grows, there is likely, if you are able to handle the administrative obligations that come with switching from an LLC to a corporation, we would generally think about an S corporation first. It's called a small corporation, a small business corporation. And in that case, you continue to enjoy the protections of the corporate structure, but then you also have some tax advantages. Generally, all of those earnings will continue to flow through. You'll have a separate small business S Corp 1120 tax return, but all of those earnings will still generally flow through, and you'll pay taxes on those on your personal tax return, just like if you were a Schedule C sole proprietor or an LLC, single member LLC operator. But here's the difference. Go back to that example. You can minimize the amount of the self-employment tax by paying yourself a reasonable wage, and you have to document what that reasonable wage is. And you'll only pay self-employment tax, you'll only pay, it becomes a Social Security and Medicare tax on that wage, and any additional monies that you pull out of the business to live off of would be done in the form of a distribution, and you won't have to pay taxes on that. So let's give a quick example, and then let's move on. So let's say, again, we go back to, I mentioned an example of $100,000. If you're an LLC, you're going to pay self-employment tax and income tax on that $100,000. The owner in an S corp, then, and you're still making, all things being equal, you make $100,000, separating the fact that you'll also have a tax return to prepare, which will probably reduce that $100,000 a little bit. But let's just keep it simple, $100,000. If you're able to memorialize the fact that as a business owner, you can justify, say, a $50,000 wage, then you're going to pay the Social Security and Medicare tax on the $50,000. You can take the remaining $50,000, grand total of $100,000. You're going to live on $100,000 still, but 50 of it is in the form of a wage, 50 of it is in the form of a distribution. Then you will only pay that self-employment tax payment, or the Social Security. It'll be in the form of a Social Security payment on the $50,000, and you won't pay the 15% on the other $50,000. And you've just saved $7,000 if I'm doing my math correctly. So that's an important thing to think about. There are things to think about, strategies, but the point is, I hope some of that resonates. And the point is, understand that warrants a deeper discussion, but I have spent a few minutes on that because it's important, and hopefully that triggers a few questions and a few light bulbs. And it's a very real strategy that can save very real dollars. So we'll move on from that if you have any questions. All right. As your business gets more complicated, i.e., you're growing, that expansion will create opportunity and it will create tax risk. Complexity will cause further issues. What do I mean by that? Well, as your business is growing right now, maybe you're doing all of the work yourself, but as your business is growing, you're adding employees. Adding employees means that you have administrative burden. You have payroll to manage. You have tax filings to manage with the federal and state government. You have real obligations to set up systems to manage that process and to make sure that you remain in compliance and that you follow those payroll rules and you make payments on a timely basis, et cetera. So there are issues around that are important. The other box, opening new locations will affect your state and local tax obligations. If you're working in state A, I personally live out of Missouri. If I'm a business owner in Missouri, I pay my taxes in Missouri, and obviously the federal government, because I'm functioning out of Missouri. So I'm earning monies, in Missouri. So there is a Missouri state income tax that is owed. If I am a business owner and I continue doing business in Missouri, and then I also open up a new location in Arkansas, just as an example, or Oklahoma, then there will be tax issues that will come into play as I move into those new locations, and understanding how to manage those reporting requirements, and besides the complexity in your accounting system of making sure that you understand the activity in state B versus state A, you would want to understand the differences in your operations from an accounting and financial reporting perspective, but then the byproduct of understanding the tax implications there as well. As your business grows, you might also be raising capital, and that you might raise that capital in the form of debt or in the form of capital infusions, equity infusions, and those raise complexities and tax issues. If you're borrowing, then you'll certainly have interest expense. If you're taking on capital infusions, you'll end up with partnership issues, ownership issues, dilution of basis, and distributing earnings, and obligations to your ownership group in terms of distribution. So there are just complexities that are involved in that. Nothing bad, and I would generally say it's a problem you want to have, but it will certainly create complexity that goes along with that. So that's why we're here to help as you are navigating those issues. Let's move on to 8 and 9, which are a couple of important and maybe understood, but I'm suspecting not understood issues. We talked earlier about the difference between expense and capital. If you're buying a piece of equipment, a vehicle, a building, something that you will enjoy the benefit of over more than 1 year, then that is generally considered a capital asset. And from an accounting perspective, you're going to capitalize that, meaning cash leaves the door. Even if you're borrowing for that, cash leaves the door to take ownership in that business. The offsetting posting in your financial reporting is that ends up as a balance sheet item, and then you will depreciate that over the life of the asset. A building, it might be 27, 30 years, something like that. A piece of equipment might be 3 or 5 years. A vehicle, again, 3 to 5 years. The US government says we want to incentivize business owners to invest in various capital items. We want to incentivize people to grow their business. So we will allow you, without these rules in place, you would depreciate the cost of that building over, or the cost of that purchase over the life of the purchase, over the life of the asset. But we want to give you an incentive to do this. So we're going to allow you to take that deduction sooner rather than later. So one way might be to take advantage of what's called the Section 179 rules, and Section 179 is the IRS code for that matter. And rule of thumb, back in the day, that was a $25,000 bonus, a $25,000 deduction opportunity. Over the decades, that number has grown to be, for 2025, it's $1.25 million. So if you buy a building for $1 million, again, there are some complexities and some rules to follow, but you'll enjoy the benefit of that immediate depreciation today rather than over the life of the building. On a multiple year basis, you may not actually save any taxes, but instead of enjoying that deduction in future years, you will get to enjoy that deduction this year, taking advantage of the time value of money. You'll have money in your pocket today instead of in the future. And so it's just a wonderful thing. I'm going to touch on this cost segregation study because that is something that is an amazing opportunity as well. If you buy a building, rule of thumb, 27, 30 years is what you would depreciate that building over. But of course, that building is made up of lumber. It's made up of plumbing, wiring, drywall, roofing. All those things are go into the cost of building a building, and those things break down, and those different components have different lives. And so the IRS has set up a process by which you can, appropriately so, and if you do it the right way, you can undertake a cost segregation study in which that $1 million building purchase can be broken down into different components. And again, there's a right way to do this. You can't just do this with a spreadsheet. There's a right way to do this. You can break down that cost into all the different components, and then apply different lives for those components. So your average depreciation might your average life might go from 30-ish years to 10 years or 15 years. And you would depreciate the purchase of that building faster, enjoying greater tax deduction and lower tax bills. So that's something that's very important and is a wonderful tax strategy for those that are undertaking capital investments. R&D tax credits is a little known thing. Again, we're not going to go into a ton of detail, but R&D, what does that stand for? Research and development. A lot of people say, well, that's clearly not for me. I'm not a manufacturer. I'm not a pharmaceutical. I'm not investing in research for long-term drugs and those sort of things. So that's surely not for me. My point is to raise awareness that there are times when these tax credits, if you're able to qualify in certain ways, if you're able to memorialize those in the form of time studies, there are tax credits that are available to you. And it just warrants a conversation about those things. Quick side note, what's the difference between a tax deduction and a tax credit? A tax deduction is a reduction from your total taxable income, and then the tax formulas, the tax percentages will be applied against that net taxable income. So any additional deduction, you enjoy your tax rates percentage of that deduction. So if you have a $10,000 deduction, then that results in, let's just say, a 25% reduction in your tax bill. A tax credit is a dollar for dollar reduction in your tax bill. So if you have a $10,000 tax credit, that is a $10,000 reduction in your tax bill. It's important to understand the difference between a deduction and a tax credit. All right, so let's move on to the next item. We're down to four remaining items. Income shifting strategies, controlling when your income is taxed legally. And again, this goes the assumption that we're paying taxes on a cash basis. It's a truth that you don't pay taxes until the money's come in. It's also a truth you might be in a situation where you are are having an unusually blip good year, and that might put you into the next tier. The U.S. tax structure is a progressive structure. The more you make, the more you pay for each progressive dollar, and there are tiers, and you might be very close to that tier. If you are able to defer payments, then you might be able to reduce that tax bill by stretching out collections into the future and stay under that next tax tier. So that's just something we want to talk about. We talk about family members and separating entities to reallocate tax income. Again, there are strategies around appropriate deductions, appropriate acceleration or deferral of income, and that's important to understand. We see a comment here from my friend Fred, who has said that their business uses the work opportunity tax credits a lot. So, um, uh, an opportunity there. He says it's usually a waiting game until the earnings are earned by employees. But the point is, and thank you, Fred, for listening and for the feedback. I appreciate your engagement. The point is to be aware of those issues and to evaluate whether they are an effective strategy for you. And I appreciate that, Fred. Nice to hear from you. Let's move to a few remaining items. Preparing for audits. It's important for you to memorialize all of your tax positions. If you're taking a tax position, and maybe it's a black or white position, you very clearly incurred a business expense, have a receipt, have a good accounting system in place to keep those receipts, keep those invoices, memorialize the business purpose for all of those receipts and invoices. Have a good system for keeping those. But you also might have some gray areas and some areas that are subject to a little more scrutiny. Just be prepared for future audits. Those things will come, and the IRS ebbs and flows about what industries to look at. And of course, materiality comes into play, but just be prepared. Document, memorialize, keep those records and file on file. Work with your accountant to be prepared for future audits. Strategic tax management, and we have just one more item after this. And the point is, all of these things are interesting to note, and some of them may apply, some of them may not apply. And there are, of course, going to be other opportunities and things to think about. And something that is a treasured strategy for one business might not be a treasured strategy for another business. And the point is to understand what your long-term business goals are, what your strategies are, what your objectives are. And I'll throw this out real quickly. Many people are trying to minimize their tax bill, so much so that they don't pay any taxes, but then they go to a bank and look for a loan, and the bank says, well, your business is showing that you're not making any money, so if I give you a loan, how are you going to pay me back? Your own tax return says that you can't pay your bills because you're losing money. So I have conversations with people all the time. You either need to be profitable to get a loan, or you can not get a loan and not pay any taxes. But it's a truth that for every business, there's a different set of goals and objectives and what you're trying to accomplish. And those goals and objectives are going to ebb and flow depending on the year and where you are in your life cycle. And just planning for those things in a strategic and memorialized way. Last thing, questions to ask your accountant. Don't just ask, and I can't emphasize this enough. What's my refund? What's my amount due? There's so many other things. I'd want to understand how much am I paying in taxes as a percentage of my total earnings before I want to understand my tax bill, my refund or settlement, because I can manage that refund or settlement in one way, and as I can manage my tax bill through the things that we've talked about today and other things. So that's something that's important to understand. But other questions to ask your accountant or call us to let us do a review with you. What did we miss last year that we can correct? What changes should we be making based on our growth trajectory? Again, I go back to there's a difference between avoiding penalties and interest and managing your cash flow if you're in a time of excessive growth, which will change your tax bill, and you want to be aware for that. And of course, the age-old question: what am I not asking that I should be asking? So those are important as well. So, what are some of the key takeaways for this session? I hope that I have clearly articulated that taxes are not seasonal. They're strategic. There are things to plan for throughout the year. There's a right time to be thinking about these things, and waiting until December is not the right time. Waiting until March or April is not the right time. So having that conversation will just help your business, guaranteed. It will help your business and you'll be better for it, just from a tax planning perspective as well as from a business ownership perspective. Your return is a roadmap. It actually tells a story. It's not just a once a year thing. And make this tax strategy a part of your ongoing financial planning and management. I reiterate, it's in the description, in our YouTube description. It's on our website. Please do take advantage of our white paper series. We're putting some great educational materials out for you to take some nuggets from. And then finally, if we have any questions, we'll also end with a heads up that there is lots of discussion about a potential coming recession, and we're certainly not going to talk about political matters on this webinar, but want to talk about how to successfully navigate downturns in your industry, and we'll talk about that next month, May 15th. It's always the third Thursday of the month, and the key to navigating and successfully running a business is not to operate only when the economy is good, but to operate in the economy, whatever it is. And as long as you are meeting the needs of your community, solving your client and customer problems, there are ways to recession proof your business and ways to continue navigating your business. And the only ones that survive are the ones that are doing that in that most effective way. So with that, I am going to see if there are any questions. We have run a little bit long, so I'm probably going to let this end sooner rather than later. Thanks again to everybody who is listening now and in the future. And we can, if you do have questions, comments, then we can put those in the chat later and we'll be responsive to those as well. And thank you very much for listening today, and continue to pay attention to this series. And if there's any topics that you would like for us to speak to the group about, feel free to let us know about those as well. Thanks a lot for joining, and have a great day. Bye-bye.